So you bought an investment property and you're recently thinking about selling it because it went up a lot in value, but you're worried about taxes. Well, worry no more, because after this video, you will know exactly how to defer the capital gains taxes on that property, not just once, but really for the rest of your life, and even have your heirs not pay taxes on the gains. Warren Buffett, one of the smartest investors in the world, always said, rule number one is don't lose money. Rule number two is don't forget rule number one. So one of the most important parts in financial success is to not have to give a big part of what you make up to other people. Don't lose money. And what is your number one cost? It's taxes. So after this video, you will know exactly how to avoid a 25% tax hit and actually compound your money much, much faster when actually, if you follow it to the dot, never even pay taxes on investment properties as you keep buying and selling them for the rest of your life. What I'm talking about is what's called a 1031 exchange strategy. So what is a 1031 exchange strategy? A 1031 exchange strategy is also known as a tax-deferred exchange. Here's the basic rules of it. If you buy an investment property and that investment property goes up in value, and if you sell that property, you technically have made capital gains. So you technically have to pay taxes on that investment. However, if you can roll that money into another and exchange that first deal into another deal, there is a way that you can roll your profits over into the next property without paying a penny in capital gains tax. It doesn't mean you don't owe them, but you roll them over, you defer them until you sell that property. And then once you sell that property, you do the 1031 exchange. You defer it again, and you defer it again, and you defer it again until the very end of your life. And then just at the end of the video, I'm going to share with you how you can even at that point avoid that your children pay taxes on it too. So in other words, in the US tax law, the 1031 exchange says that when you sell an investment property, the government allows you to roll over the profits into a similar kind of property if it happens within a certain kind of time period and following a certain amount of rules. So let's go through those rules right now. Number one, as already mentioned, it only works for investment properties, not for your personal residence. So first of all, you got to become an investor. Go buy yourself a rental property, go buy yourself a commercial property, go buy yourself a multifamily property or anything like that. Manage it well. As it goes up in value, you can use this strategy. Number two, when you sell the property, you have 45 days to identify up to 3 different replacement properties. Number three, also from the day of the sale, you have 180 days to actually close on at least one of these replacement properties. Number four, the properties need to be what's called like kind. So you can't take a single family property and sell it and buy crypto with that. That doesn't work. You can't take a multifamily or any kind of real estate and then change that and exchange it into the stock market. That doesn't work. But you can take a single property rental and replace it with a multifamily rental. You can take a piece of land and sell it and then replace it with a single family or multifamily rental. You can take a multifamily property and replace it perhaps with an office building, because they're like kind in the sense that they're real estate, that they're investment properties, that they're income generating, and so on. So it's the same class of asset. It's real estate. So from real estate to real estate works. From real estate to non-real estate does not work. Number five, you cannot hold the money yourself in that 45 and 180 day time period. Instead, if you want to do a 1031 exchange, what you need to do is before you actually close on the sale, you need to let your title company know that you want to do a 1031 exchange, and you need to establish a relationship with a 1031 exchange custodian. So before you actually close on a transaction, before you actually finalize the sale of your investment property, you need to let the title company know that you want to do a 1031 exchange, and you also need to establish a relationship with a 1031 exchange intermediary. So you need to basically sign an agreement with them. They usually charge about a fee, $1,000 to $1,500 per transaction. Then you need to introduce them to each other. The title company and the intermediary need to be introduced, because the title company then needs certain paperwork from the intermediary that tells them that the title company is authorized proceeds from the sale. Instead of sending them to you, they send them to the intermediary. And that's very, very important, because you cannot receive that money back and then use that money for 45 days or 180 days to do day trading or whatever it is, and then re-exchange it in the other one. That does not qualify. The money can never touch your hands. It needs to go from the title company to a certified or licensed 1031 intermediary, and then that intermediary, when you have the replacement property, sends it back to the title company to be used to purchase the replacement property. And that was actually the next part of the rules here. So again, the intermediary holds the money, and then once you have the replacement property under contract, once you have the replacement property, you're ready to close on your purchase of the replacement property, you then advise the title company and the 1031 exchange company to actually go fund that deal with your money. The exchange company then sends the money over to the title company, and that's being used as your down payment towards the new kind of replacement property. Now, important to note is also what happens if you don't find a replacement property, or if none of the 3 properties that you selected as replacement properties actually pan out and they fall apart for whatever reason. Well, in that case, what happens is once the 45 days are over, either if you did not select a replacement property in the 45 days, then on day 46, the intermediary actually sends you the money, and now you owe the actual capital gains taxes. Or if you selected replacement properties, but within that 180 days, you couldn't close on any of them, then on day 181, basically the intermediary sends you all the money, all your proceeds from the initial sale. You now have control of the money, but the exchange has failed, and you now owe the capital gains taxes on the sale of your initial investment property. So therefore, trying for that not to happen. Make sure that you only sell the property, or you delay the sale if necessary of your property until you really have a identified replacement kind of property, because otherwise 45 days go very, very quickly. It's only a month and a half. And if within a month and a half you haven't figured out a deal that you can put the money back in, and then you actually owe the money, and that can cost you up to 25% of your profits that you made in the initial sale of your investment property. So again, make sure you have that all lined up. Let's actually go through a quick example. And by the way, if you have questions, make sure you put them in the comments right now. I'll be happy to answer them. So let's talk about a deal. Let's say you bought a fourplex for $700K. Okay? So you bought the fourplex for $700,000. Doesn't really matter how much you put down. Bottom line, only what matters is how much did it go up in value. So you bought it for $700,000, and now it is worth, like whatever, 3 years later, or it's years later, it's worth $1.3 million. Okay, great. So you made a $600,000 profit on that deal. So you're like, great. My fourplex is worth $1.3 million. I want to go sell it now. Fantastic. Remember though, if you just sell it, you get to pay taxes on the $600,000. You don't want to do that. Again, there's a sliding scale in capital gains. It starts at 0, goes all the way to 25%. So in this case, it might cost you 20% capital gains tax. That's $120,000. You don't want to pay that. Instead, here's what you do. You go find a replacement property. Let's say you find a small strip mall, and that small strip mall is worth $2 million. So that's worth $2 million. You identify it as your replacement property. You now sell this property. What happens is the full $1.3 million go to the intermediary. It's column I. The intermediary gets the full $1.3 million. Let's assume this property actually you bought it free and clear. Let's not mess with loans. It just complicates the numbers. But the point is, you now have $1.3 million in assets. That goes to the intermediary. You do not touch that money. The intermediary keeps it. And now what you do, you have 45 days to identify that one. Well, you identified the $2 million loan, $2 million strip mall. You have 180 days to actually close on this. and then you proceed with the closing. So now you proceed with the closing, and part of that is obviously you have $1.3 million, but you're buying a $2 million asset, so you need a $700,000 loan in order to pull that thing off. So you go to a bank, you get the loan, you get it lined up. It might take 90 days to get this all, or 60 days to get this all lined up, but it's just fine because you have 180 days to actually complete this transaction. So now, whatever it says, day 75, everything is set. You're closing on that deal. What happens next is very simple. You sign the title company comes in and says, okay, we need $2 million to buy this deal. The intermediary now goes and submits $1.3 million. The intermediary sends the money in there, plus the bank loan comes in at $700K, right? And now you have $2 million to close on the deal. You now own a strip mall worth $2 million that you bought for $2 million that produces more cash flow than your fourplex did before, that continues to appreciate now going forward. And as an extra kind of bonus, which is the entire goal of this entire strategy, is you have just deferred your $120,000 capital gains into this next property. You don't owe $1 in capital gains tax. Instead, you rolled it over into the next deal. And now here's the key. What do you do when that strip mall went from $2 million to $3 million? You do the exact same thing. You sell the property for $3 million. You pay off your $700,000 loan. So the intermediary now sits on $2.3 million. This $2.3 million, you use that as a down payment for a $4 million, I don't know, whatever it is, small apartment complex. And so with a $1.7 million loan, and you repeat that again and again and again until the day you die. Now what happens on the day you die? The day you die, all your assets go to your children. But under current law, the beauty of real estate kicks in, that your children do not take this real estate over at the original value, the low value, but there's something in the tax law that says there's a step-up provision. That means that the moment that you die and your children take over, the value gets stepped up to current market value, and your children take this over at current market value without owing any taxes whatsoever, as long as you don't inherit them like hundreds of millions of dollars. If this is one deal that's worth a few $1 million, it's below the limit of your estate, they can take this over without paying taxes. And now guess what? They start doing the exact same thing during their lifetime. So when they're ready to sell it, they exchange it into another property, and then into the next one, and then to the next one. And over time, you can literally delay taxation of your assets and allow your assets to compound and grow much, much faster without ever paying taxes. That's the beauty of the American tax law. Now, if you don't like it, then hey, don't blame the messenger. The point is, it's there for you to be used. Use the tax law. You can do the exact same strategies that the rich do by applying the exact same method. And in the process, you can become rich. All right, if you enjoyed this video, make sure you subscribe, because there's many more videos where I explain exactly how you can save taxes through real estate.